leave the room. Cool. Hi, everybody. Welcome to Trading Tuesdays with the Blockchain Center, powered by the Bitcoin Center in Miami. I know a lot of you have been looking forward to this event because we have some elite traders. We're going to be talking about just post-halving 2020, all of these guys' ideas on the market, especially considering what is happening right now in all of the traditional markets, the 30 million people that are now on unemployment. So I'm going to let each of you introduce yourself. We do have one more person that's going to be joining us, but we have professionals here, so I'm going to let you guys take it away.
Who wants to go first?
Go ahead, Dan. I guess you can go ahead.
I'll lead off. Thanks, Rosh. My name is Dan Tori. I'm the head of institutional sales for the Americas at Genesis Trading and Genesis Capital. We are a company that is owned by DCG, Digital Currency Group, based in New York. For those of you in the audience who are not extremely familiar with DCG, we've been in the digital asset space going back nearly 8 years now. And that includes Genesis Trading's OTC, crypto institutional market making business as well. DCG also owns CoinDesk, which is omnipresent in the space, Grayscale Investments, and again, Genesis Trading and Genesis Capital. As far as what we do at Genesis, real quickly, I don't want to take up too much time so we can get to the other panelists. Genesis Trading is an SEC and FINRA regulated broker dealer, again, based in New York. We have a BIT license from NYSDFS, and our primary business is institutional only trading and market making of digital assets. That business goes back to 2013. In 2018, the company launched Genesis Capital, which is our institutional crypto lending arm. We're the world's largest institutional crypto lender. We currently have over $900 million in loans outstanding in notional amount in our loan book, and we've originated more than $6 billion in loans to date since inception in March of 2018. It's an institutional only business. We service a fairly wide range of institutional investors within the digital asset community, from professional trading firms to other market making shops, the OTC arms of exchanges, miners, high net worth family office, even VC hybrid folks, and devcos. We want to support everybody in the space who needs help with liquidity, and we're very, very focused on growing the ecosystem while we grow the business. And
hey, sorry, I'm here. I'm missing a party here. Sorry, just crashing this party. What's going on? What'd I miss? Can you hear me?
You're up.
Oh, okay. Are we doing backgrounds? Is that what we're doing?
Yeah, go ahead, Ture.
Hey, sorry, a little late. Tori Johnson here, joining the party a little late. Quick background, been in the foreign exchange markets for 30 years, started in 1990, Bank of America spot trader, moved into strategy, prop trading, and then in 2000 left the banking side, went to the buy side, couple FX only hedge funds, had my own hedge fund for a while, some bigger hedge funds, and then went to the high frequency space in foreign exchange. Where I was at Tower Research Capital for 5-6 years. Left Tower, went to Seabury Global Markets, which is a fintech company. That's where I got first introduced to crypto. They have partnerships and investments in technology, crypto related, and in custody relationships. And that's where I started learning the process of crypto and what goes on. And most recently joined Floating Point Group, which is a direct market access, algo execution, small to router connectivity in the space. And that's where I am now. So I hope that got everybody caught up to speed.
Yeah, awesome. Thanks for that. Sure. We've never met, but I've met your team, Kevin and Jared. We were frequently meeting at the WeWork office space we were sharing. We weren't sharing the office space, but we were in the same building on 79 Madison. But no, these guys, I guess you guys moved out to Brooklyn, but since the quarantine, we're all working from home. Hasn't impacted us much because most of our team's been decentralized to begin with. A couple of founders are based in New York City, but rest are, across the globe, basically. So just to give you guys a little background about myself, Rosh Singh, CEO of Quadency. Quadency is a multi-exchange crypto trading terminal. We are currently connected with the leading 12 or 13 exchanges, and our primary focus is retail traders. And my background personally, I've spent about 10 years in the FX markets. I was the co-founder and CTO at FX Junction, which was a social trading platform. And prior to that, I spent some time leading engineering at FXCM back in the days, around 2004, 2005. More recently, before I started Quadency, I was at LearnVest, also leading some initiatives around technology and building personal financial planning tools. So background's heavy in engineering as well as trading. Traded FX on a retail basis with multiple entities, and eventually one of the entities acquired FX Junction, which is one of the reasons I moved on to doing other things. So currently leading Quadency, and with a goal to help retail investors succeed in these markets. We all know it's quite challenging, very volatile, and we're trying to build the tools that they can use to actually be successful, whether they're measuring their worth in BTC or USD. They can do so easily.
Rush, so if I'm a retail investor, and instead of going directly to an exchange, how do I use your platform, and what benefit does it give me to go to your platform instead of just going right to Gemini or Kraken or Binance or something like that?
Well, if you've traded with any of them, you probably realize that there's a lot lacking in terms of professional tools for series traders. So that's kind of where we saw the gaps, and we wanted to fill those gaps for professional traders that need to do chart analysis and really be able to screen the assets that they're trading, get a background on them all in one place, and also obviously automate the trading strategies. And trading strategies could be as simple as buying over time DCA. So if you want to buy a certain amount of asset and you want to accumulate that over time, you can do that with one of the bots that we offer. There's other bots that actually trade based on technical indicators. We have one coming up soon that lets you hook into TradingView. So if you've got chart setups and alerts set up in TradingView that you want to execute based on, you can do that very soon with Quadency. But we have a quite comprehensive library that's growing right now of strategies that let you do, for example, market making, or soon arbitrage as well. But there's grid trading, all kinds of strategies that are very popular amongst retail traders.
So are you an exchange, or are you simply a smarter router in a sense, connected to multiple exchanges? I'm sorry, I don't know the answer to that question. I'm just curious.
We're more of a terminal with automated trading functionality. So if you're familiar with, if you're from the FX markets, I would equate it more to MetaTrader in that sense. So you know how MetaTrader allows you to trade with multiple brokers. You can switch accounts and connect with different accounts.
Gotcha. Okay.
So you would still need an exchange account. Our traders trade on Binance, Coinbase, Bittrex, Kraken, Liquid, you name it, all over the world. And you need API keys to be able to connect your account. Once you put in your API keys, all of your portfolio is visualized on the dashboard, and you can start placing trades and executing strategies.
Gotcha. And Morgan, I don't know if you gave your background yet. I may have missed it.
No, I didn't. I get a chance to yet.
Okay.
Yeah, I'll go. I was actually trying to figure out the software here, so I'll just I'll send out my Twitter handle to you guys. So I've kind of got started right before the whole blockchain crypto thing took off. I mean, I initially had exposure to it back in like 2000, I think like 12 and 13, and we were actually trading Bitcoin over the market, OTC, out of an exchange in Florida, and we were debating on setting up our own. And I remember my partner at the time was really adamant we do it, and I didn't get it. I was like, okay, why are we spending all this time to set up, some kind of an exchange for this really, thinly traded, made up product that only a handful of hackers know about? Like, I just don't get it. But yeah, now hindsight, 2020, he had the vision of what was going to happen. So, we didn't become the next Coinbase, but I did learn how liquidity works for it in particular, and, just kind of how it would start, and it's evolved, and it seems to be, for better or worse, it's going to be like the digital dollar. That's kind of how I've taken it. So what have I done since then? I basically was running my own hedge fund, doing high frequency trading. We had a lot of different, cross assets. We're doing equities, options, some Forex and some commodities, a couple mandate changes with some of our investors. And I decided to quit that and go to work for the opposite side, the regulators. So I did about almost 3 years at a regulator, FINRA, of course. And I learned all about the risk side of it. I was with the Office of Risk. So we learned how to measure, how to quantify, and how to control for every type of basically every single risk category out there, from, cybersecurity to sales and trading risk, where, you try to sell a grandmother a 100-year annuity or something that she'll never see cashed out, something like that. So I learned a lot, kind of both sides. And that's kind of where Peter actually was the guy who drugged me back into it. He just came and he said, "So what do you think of cryptocurrency?" And I was kind of like, "You mean like Bitcoin? Like I used to trade and just kind of muck around with it?"
Don't blame me.
Yeah. Anyway, so that was kind of the impetus for what happened. And ever since then, I've kind of been investing, looking at it. And about 2 years ago, I started basically a version of a hedge fund for crypto with another trader who's been trading for the last almost 20 years now. And he's been running his own hedge fund in Connecticut. So we basically launched a crypto arm of it and have just been kind of basically trading in and out of the markets with a lot of different strategies, mostly automated with dual risk layers. Pretty interesting things. We tried to model ourselves after like 0.72. Basically, we kind of took some of their best practices and applied it.
So how do you? So these are all automated black box. So you have your logic running somewhere, and you're connected to liquidity, and they fire off an order when something's signaled.
Yeah, exactly.
What's your sort of average hold time on these on the trades?
So we have different kinds of strategies. We do have some longer term core positions that could stay open for maybe a maximum of like a month or two, but that would be it. Most of them are in or out in days to hours. So the average, given all the trades we do, if you average it, you're looking probably at, I would say maybe 5 to 10 minutes, maybe something like that.
Really?
But again, you're like, you have core
positions. So are you making or taking?
We're doing both. It depends. If the market's quiet, we'll usually be a making, but if it's moving a lot, we'll take the risk and just take it.
I'm just wondering how the fees, I know the fees are pretty skewed to the taking side to be pretty bad.
Yeah. I mean, there's a couple of things we do that's differently than other crypto funds. So we actually use overseas prime brokers. The reason is very simple. It's because we know what we're doing. They've dealt with volatility in the FX with 100-to-1 leverage for 20 years. So they're not some fly-by-night shop that's going to have a problem with operations when things go south of the market. And we have multiple of them, so we have diversification. So even if one blows up, most of your assets will be fine. And then, obviously they have more of a regulation regime, something like FCA. Obviously some of them qualify in the US, but we don't really use those directly. But you have insurance as well. So everything's been kind of, set up and been used for many years for FX. And a lot of it just translates really well to crypto. So the only thing we, can't say is we can't say that, not your keys, not your coin per se. And we usually have to settle in US dollar. but we are allowed to trade in and out with crypto. We can buy and sell crypto just like anything else. So it really depends on what we're looking to do. But it's been quite a good tactic for us to at least use margin, use a little bit of leverage, and have a lot better liquidity, because if there's not enough liquidity in the market, rather than having to worry about Brock Pierce or somebody take the other side, you just have the broker do it.
So I apologize, I'm asking too many questions here, but I'm just curious. When you say prime broker, I think there's a big, at least in my short period of time here in the crypto space, prime brokerage gets thrown around a lot by a lot of vendors in the space. And when you really talk to them about it, you realize it's not really a prime broker. And they kind of try to relate it to FX. And I'm just curious. So when you say prime broker, I understand prime broker in the FX world, and obviously Dan's been doing this forever. But so I mean, are you getting a margin and trading anonymously through exchanges, trading through a prime broker name, or how does that work? I'm curious.
Yeah. So they're basically allowing us access to several different markets. And some are better than others, but essentially you're getting indirect exposure to a bunch of different exchanges. So the exchanges are providing the liquidity to the prime broker that we're using.
And does that prime broker give you leverage?
Yes.
Okay. Interesting.
Huge advantage, especially when the market's moving.
Yeah. And then what, you settle every day?
Yes.
And you cash settle every day?
Yes. It's a pretty good setup. It's much, I'd say, superior than most of them out there.
Gotcha. Okay. Gotcha. And Peter, I
last but not least, right? That's how you can
well,
describe
I don't know. Unless I miss Dan speak.
He was the first. He was the second.
I'm saving. Dan aged well here, so I'm waiting for him to go last here if he hasn't already spoken. So, but no, Peter, go ahead.
So what we do is, my name is Peter Borovykh. I'm the co-founder of Ronin AI project. The Ronin AI project is pretty much a combination of blockchain and artificial intelligence. So we use artificial intelligence to forecast direction of cryptocurrencies, of the major 5 cryptocurrencies. We have 3 academic research papers published on the topic of neural networks and the efficiency when it comes down to forecasting prices. We are using very small timeframes, 1-minute data points, to forecast pretty much the next minute. And then we smoothen out the results to make sure that the average holding period is large enough for the fees to not kill the profits. We are shooting for 30 to 50% annual returns. Obviously, that's expected given historical performance. And we are offering that analytics to both retail and institutional investors. We are a global company because of regulatory climate here in the US. So you have to make sure we're very careful. And the blockchain side comes from the fact that we are also distributing hardware devices that serve as both feature nodes of the blockchain network, and therefore serve as a hedge for our users, and also serve as an auto trader when it comes down to automated portfolio management with our analytics. So I apologize, I do not have a face. My camera got broke. So the face that you can see with the picture is pretty much the best I was able.
I just thought you were being very still. I don't know.
Yeah, exactly.
But so and clients subscribe to these signals. They pay for this signal service and they subscribe to it. And so if you're looking at 1-minute bars, I mean, it must signal pretty frequently.
So we make sure to smoothen them out for the average time frame of roughly 1.5 signals per day. That's the rough holding period. For each crypto, we are offering 9 trading strategies at the moment. The goal for us is not to be a signal provider. The goal for us is to build a decentralized exchange, decentralized network down the road. And the best way to do that is to first build the community and then have the technology, as opposed to build some crappy technology that nobody cares about and hope that they will come. So we are building everything from scratch. The average net worth of our user is about $1 million. we are pretty much represented by this decentralized network from 17 countries. So that's what we have.
Oh, okay, interesting.
That's the intro.
Dan, did we miss you talk? Or did I?
Conversation where we're at now, and I think where the conversation might be going is I also come from the FX market, like Ture and like Rosh. I spent 16 years in the FX market before I made the leap into digital assets. Before that, I spent 7 years in equities. I see a tremendous amount of similarities in terms of market structure, in terms of the manner and the pace, and a lot of the aspects of how this market's evolving, particularly the institutional crypto trading market. Tori, I'm sure you see it. Rosh, I'm sure you see it as well. If you look at crypto today, if you look at e-trading in crypto today, it reminds me of FX 25 years ago in terms of, again, that pace of evolution, of development, the infrastructure that's being built, the manner in which people are trading now versus a couple of years ago, what it's doing to spreads, the manner in which folks are attempting to achieve price discovery. I want to hear what the rest of the panel has to say about that.
I'll throw my 2 cents in. Dan and I think we may be the only ones around who remember the gold standard. And when we came off the gold standard, saw that transition and saw, back in the early 90s before, before the advent of really computers and electronic trading and stuff. And it was all, FX was all voice and spot, right? And then in the late 90s, I was working at Bank of America at the time, and, somebody said, hey, we're going to do this thing called prime brokerage. Like, what's this prime brokerage stuff, right? And at the same time, someone else said, well, we're going to do this something called e-com. And it's like, well, what's this e-com thing? And they both were sort of launched together in the second half of the 90s, started really taking off in the late 90s, I guess. And in my opinion, one without the other would never really taken off. If all you had was prime brokerage, and you didn't have electronic trading, just and the way the foreign exchange market is so fragmented and it's a very, very credit driven industry, and it's fragmented. And prime brokerage allowed, obviously hedge funds, CTAs, and it allowed the retail firms to come into the space, the FXCMs and the OANDAs, and it allowed the high frequency prop trading firms, because it was fragmented. They were able to take advantage of some dislocations, right? And prime brokerage allowed all those participants to be involved. I hear a lot of comparisons in a sense about, well, this is digital assets is what FX was 25 years ago. Maybe true, but the massive difference is, back in the late 90s, there was a real need from institutional players, right? Whether you're a corporate, sovereign wealth fund, whatever, international trade, there's a real demand for that type of products. And so Goldman Sachs and Citibank and Deutsche Bank, they all supported prime brokerage, and they all supported electronic e-com. So they had those massive balance sheets and money that went into it. And then it trickled down all the way down to the retail firm that enabled retail firms to do that. In the crypto world, and they set the standard. I mean, there really wasn't much difference. And I know Dan and maybe Rosh know better than I do on that side of things, but there really was that much difference. There was a PB at Deutsche, there was a PB at Citibank, there was a PB at JP Morgan, but they all sort of looked alike. It was just who gave the better deal and whatnot. In the crypto world, it's the complete opposite, right? I mean, the last group of people in the industry that come into it are going to be the Goldman Sachs and Citibanks and JP Morgan. So right now, this started, from some smart people, let's say, who said, hey, I got an idea, let's create this digital. And then all of a sudden, some people said, hey, let's start an exchange. And I read stories from 10 years ago, people had to go in chat rooms and they had to physically exchange money and then swap wallet addresses. And someone said, hey, let's have an exchange. And that came from the ground up. It wasn't supported by, some financial institution. So now there's an arms race in our industry for vendors to solve their, whatever it is they may be trying to solve, whether it's custody, credit, connectivity, exchanges. And then finally, one day, one of the big global institutions, if they don't collapse the next year, they'll come out and say, hey, we support this. But, they'll be the last ones in. Back then, they were the first ones in. That's how I sort of see it.
Yeah, just from my perspective, I've been around FX, like I said, around 2005. Spent about 10 years in the space. Since then, I've been kind of following Bitcoin from the sidelines. In the early days, I saw just randomly browsing forums, I came across Bitcoin, and I was like, oh, what is this? This is interesting. This is supposed to be a global currency. You can send it to each other, but who are you going to send it to? There's nobody on the other side. So, exchanges started popping up slowly. But even before that, there was this, go deposit X amount in this, Bank of America account, and we'll send you BTC. I think that was BitInstant, who was one of the first services back in 2011, 2012. I kind of dismissed it around that time, unfortunately for me. But then I picked it up again as I kept seeing Bitcoin come around, get talked about in Bitcoin in FX forums and trading forums. People were really excited about the moves that it was making. It would go from a few cents to $1. It would go from $1 to $70. So around 2013 is when I started taking more interest in it, and I saw that the space was obviously not ready for any kind of prime time or mass adoption. You saw the Mount Goxes come about. I actually have experience trading on that platform, and I was like, who the hell put this together, And then, we've come a long way today. Infrastructure has improved. From our standpoint, we provide connectivity to all these major exchanges. We've seen just in the past couple years since we started that the APIs and the performance and the robustness of infrastructure is definitely improving. But there are far and few exchanges that offer what's common in the FX space and equities, which is the fixed connectivity. If you're doing any kind of high frequency trading or market making, you don't want latency, and you want to be able to execute fast. So before the JP Morgans, enter the picture, I think we have some way to go. Without that, there's not that much liquidity to be playing with for large players. Outside of Bitcoin, I think majority of the altcoins probably today comprise less than 30% of the entire market cap. So, you guys know better about the institutional space, but the primary focus for the big guys is Bitcoin mainly, and maybe the top 5 or 10 coins.
Yeah, Morgan, you have a hedge fund, right? So, how do you handle the liquidity? Are you doing size that you get slippage and move the market? Or do you know any idea what your impact is on the liquidity, and what do you do to minimize that?
It's really simple. You just try to put your biggest trades on when you have the most liquidity. You try to VWAP in, basically, volume weighted average price. So we don't try to put on hundreds of Bitcoin on a Sunday night. That's not advisable. But, like a Friday midday when London's open, or, in the morning when, Asia's closing, that might be a time to get a little more size. Bitcoin's interesting because so much of it comes from China, and you have such an interesting liquidity factor coming from China, where, half the mining power is basically in, basically mainland China. So that's always an interesting factor to consider but overall, it hasn't really been a huge factor from us because we're not moving, that much. We're like, I think we're like 25 million or a little under that. So, we're not going to leverage the whole thing. So you're talking about, maybe $1 to 2 million US dollars worth of Bitcoin at a time. So it's not really that big of an issue. And that's again why we're using a broker with the ability to use leverage and have them help us settle through counterparties. Because if I was putting on one, even ItBit or Kraken, sometimes you do get slippage, and sometimes you take out the whole order book if you put more than 10 coins on there. I've seen it lock up with just a handful. So in those, you have to either go through a broker like Genesis or someone else and actually settle off the market, off the exchange, or you're just going to have to deal with the slippage of it. But I mean, all these things are going to keep evolving, I think.
Do you deal? I mean, obviously you have your exchanges, but now seems to be a lot of non-exchange LPs, right? Right. They just give you an all-in price, their fees and all that.
And so I think we lost you, or I think we lost you.
Because the question is about liquidity. Where do you guys source out the liquidity from? Oh, he's back.
Oh, sorry. Yeah, Tori,
you dropped off. I'm having a bad internet connection or something because I keep kind of going out here. I don't know.
No, we haven't. So Peter said it's sourcing liquidity. So no, we don't really have to source yet. We haven't got to that stage. But I do have a list of LPs that when we need to go to, we can get up to like $1 billion worth of liquidity for Bitcoin. So that is something I think any fund manager in the space should have a list of and be aware at, and kind of keep up to date on kind of what their their specification is, what price, what quantity they can deliver, time to settle, all those things. Because it's like a raw Wild West FX market where you have a bunch of different players offering diversity of size and allocation in different coin sets. So it's actually been quite fun to kind of navigate through that. And personally, I hope we can do this as a community and keep the big banks out, because really, what do they have to offer us other than debt?
Right. Yeah.
Folks, we're getting some questions from the audience. One that came in asked the question, and this has come up a little bit. Lomax Dustbin wants to know which prime brokers out there are the best, and do they really exist? I want to start by asking Morgan a couple more questions, because he's utilizing a provider today that he calls his prime broker. If I could just, we started to go on this, but then we veered away. If you could tell me more about the services they're providing for you today. So they're giving you access to exchanges. There's a pre-funding aspect. They're giving you leverage. Are you trading in their name, in their street name on these exchanges, or is it more sponsored access directly? You're trading in the name of Attis Cap?
No, I'm trading under their name on these exchanges.
Involved. And are they offering custody as well?
Yeah, some of them. Yeah, they actually are offering custody. That is correct.
Gotcha. And what about beyond spot? Does Attis Cap trade futures and options as well?
Yeah, we do, but we don't really trade for crypto futures or options yet, just because the market is still so fragmented. Again, I'm a little bit weary of taking the counterparty risk with them, because we don't really. It's just they're so new. I'd rather wait until one of them blows up and loses everything. Then we know where the risk is. We know what happens when they have that event, and we'll understand how they're going to deal with it. But I don't want to be that guinea pig.
Right. Gotcha. Thank you. So it sounds like what they're offering you is a lot of aspects of real world prime brokerage, but it's not the full package.
Yeah, it's basically because they're trying to basically parlay what they've already set up into crypto. And they're able to do that because they're not a bank. They're not as extremely regulated as, Goldman Sachs or JP Morgan. And they have a lot of offshore international customers. So they're able to do that. But I'll tell you, even like in our situation, they're only able to do that with us at the moment because they know we're a fund, we're established, and that we have the ability to cover any kind of issues that come up operationally or financially in our situation. But it's not, it's not ready for retail yet. But this is the process we have to develop out. We have to get this kind of pipeline, this kind of service set up so that, you won't need as many, it'll basically become everything that you have for equities or commodities right now, but for crypto. And at that point, that's when it's going to hit the mainstream and, be established. But yeah, you have to have two things, right? You have to have the money and institutions behind it, even if they're self-made, but you have to have at least the people behind that. And then you have to have the hardest part is figuring out the technology that you want to utilize for all the pipelines. And that's what people are still trying to figure out. I mean, half my conversations begin with, do you guys use Fix or not? And some of them are like, web sockets, like it really depends. Like a lot of protocols have to be, I think, kind of delineated out and figure which one's the best.
For that, it's really useful. If I could ask one follow-on question on that, you mentioned the fact that they've got a lot of offshore clients. So, if a client is onshore in the U.S., can they get the same range of services provided by this?
No, not a chance. The U.S. regulation regime is so draconian; they don't even have a prayer to get that unless they're a millionaire. Literally, this broker will only deal with them if their net worth is basically 10 million or more. It's like ECP level. So I think it's like eligible contract participant. They have to be that, and if they're not that, they have no chance.
Needs is for a PB to step in to help out funds who actually want a regulated solution.
Yeah, no, it really is. It's really needed.
I think we're going to be seeing that market very soon.
What do you guys think is going to be needed? Is it the prime brokerage and safety of funds and security of funds? Is that the anchor that brings institutional money and client, real client money into the space? Or what do you think brings it in?
It's going to be a big piece of it. Absolutely.
Most of these big, these hedge funds, they'll have a single prime broker, right, where they trade all the traditional asset classes out of, and that holds all their client funds and whatnot. So, and one, those they have fiduciary responsibility with client funds, and so they're very leery of taking money out of a traditional prime brokerage in the first place to move it to a crypto-friendly prime broker. And I know that a lot of guys are scared about that. And then they're worried about the workflow. I think Morgan, you were mentioning it. The post-trade settlement, the connectivity, how things get settled. Do you got to send money out to the exchanges? I mean, how does that workflow work for you, Morgan? How do you see that growing over time to bring trust into the market for security and safety and an understanding of the workflow?
I mean. It's very challenging. I'll be honest. Like we've gone through several iterations, and it's difficult because you're like, first of all, we trade multi-asset, so I've been trying to find solutions, for example, custody that will allow you to connect to traditional assets, like use like a Sterling platform and trade equities, and then you can also devise your own system where you could send out fixed signals. Let's say you have an algo that monitors breakouts on every asset class, right? Wouldn't it be great if you could just have that look across all the assets and then automatically send out trade orders no matter what it is? If it's gold, if it's oil, if it's if it's an Apple stock, if it's a US Treasury bond, like that's kind of our goal. But we're so far from that operationally, and just you're trying to just find one custodian that would actually feel comfortable holding both like crypto assets and non-crypto traditional assets and sending them to multiple brokers that do both, or one or the other, and just say, okay, your crypto will go to Coinbase or Gemini, and your equity orders will go to like E-Trade or Interactive Brokers. We can't even find somebody who's doing that yet. So we're a little bit a ways from that process. I know there's a lot of people who want to get into this though, and they want to do it because it will open up doors for a ton of money to flood in. But I just, it's been a lot of work just to get the basics we have, which is just a custodian who will accept crypto, and then we'll place it with a broker that has, via CFD contracts, we're allowed to trade both. But if we want to hold the actual asset, we're still not allowed to do both at the same time. So we have to have separate brokers for that. I'm curious about what Rosh thinks about this. So it's definitely impacted, that whole side as well.
Yeah, I mean, on the point about liquidity, we've seen the pain from not only the traders but also blockchain projects. So we have a few clients that want to provide liquidity for their tokens, and we have some services that we provide to them. They can self-service themselves and run the market making algorithms that we offer to provide more liquidity, and that makes the asset more attractive to traders, and it brings down the spread and the volatility of the asset. So there's a few things that we do in that line that actually help with liquidity, and there's others that use our algorithmic trading framework that we built out to do all kinds of strategies that we have no idea what they're running, because they're in private environments that we've deployed for them in a custom manner. So yeah, again, we're largely a technology provider and software for retail traders, and we also cater to the institutional types, quote unquote, I would say, because the word institutional gets thrown around a lot, but it doesn't really have the same meaning for everyone.
So the clients, do the clients trade through your name, or do they give you their API keys and then you connect their accounts to your platform, or do they transact through you and it's in there and through their name, your name? I'm sorry.
No, they trade on their own accounts. So if they're trading on Coinbase, they would connect their Coinbase account with API keys and use our software and algos to do the execution.
Awesome.
Guys, can I bring in some metaphysical point of view? I mean, the real question, I don't think the problem is the lack of prime brokerage in the US/UK, right? These are the top two financial markets. Probably the main reason is the fact that US and UK at this moment, unless they did create Bitcoins themselves, like the actual network themselves, I think there's just lack of control. And I mean, I know that I'm sounding like, whatever, libertarian/anarchistic in this specific situation, but it seems to me that unless the level of control is heightened to the point where the markets could be more or less controlled, and where the source of the supply could be more or less controlled, I don't think it's very likely that developed markets will ever properly enter the game of digital assets. Again, I'm not talking about digitizing whatever, securitizing real estate. I'm talking about actual speculative assets. Just my point of view. So we're looking more at Singapore, Hong Kong, potentially Russia, definitely Middle East, some parts of Latin America. Potentially that's where the epicenter of the growth in crypto could happen much faster. And again, that's not because of regulatory climate. That's not because of lack of proper regulatory climate here in the US when it comes down to regulating those assets. It's more about the metaphysical kind of who controls this stuff, right? Because think about this, every single global asset that is out there is really controlled. That's just the name of the game, right? So we can spend another 5 years trying to lobby the proper laws, but is it really going to happen? Your thoughts?
So are you saying someone's controlling? What was I missed the you're saying traditional asset markets are controlled somehow? In what way? One, do you mean that? And two, how does that? What do you mean in Bitcoin?
Way more predictable. When it comes down to commodities, way more predictable. Same thing with stocks. I mean, we know the names of CEOs. We know the names of people.
Okay.
We do not know. We know the names of the miners. Well, guess what? The revenue of miners is dropping significantly. So now, who is really controlling Bitcoins? Those who loaded up before. Do we know those names? Maybe we do. Maybe we don't. So unless the cluster of individuals and enterprises controlling a large chunk of those Bitcoins will be more or less enabled, chances are the regulatory climate in the US and the UK won't get any easier. That's a thought for consideration. Thoughts on that, or you guys just technical?
Phew. Yeah. All right. So I guess so when you said it, prime broker isn't, prime brokers isn't the what's necessarily needed is that, and you're saying you're wondering who controls what 80% of the coin that never moves from a wallet to a wallet, it's just stuck in a wallet, it seems, or whatever the percentage is. Are you saying what gets those guys to move? I guess I'm maybe missing the point.
Guys, did anybody understand what I said? If not, maybe you should skip it. It's a very philosophical, long kind of conversation about this stuff. All right, let's go on, guys. Sorry.
I don't know. I mean, there's a lot of like Morgan's look at this stuff. I mean, and to me, 2 years ago, Bitcoin was just something that moved up and down in a chart that I could make money from the old days of trading foreign exchange and other asset classes. And you get foreign exchange volatility, no matter how you want to look at it, was at absolute historical lows back in February, right? I mean, FX Week had on their cover article, it was like FX vol was dead or whatever. And then obviously the world started falling apart and the volatility picked up again. But so a lot of people are looking at crypto, and I know a lot of systematic CTA funds are looking at crypto because their FX portfolio hasn't made money in years. So they're going, we're looking at, there's an opportunity here, but these guys are afraid to come in. And I don't think they're thinking about it in terms of who owns this coin or not. To them, it's just an opportunity to make money. But they're all leery about coming in. And, 2 years ago, there was a mad rush after Bitcoin went to 20,000. You guys remember 2018 into 2019? Every other day, there seemed to be some new vendor who came out. It was just shocking. I mean, that was my first, when I was at Seabury, and it was shocking how many meetings that took place with all and now you don't hear those names anymore, right? You just don't hear those names anymore. And I won't mention any of them, but I'm sure you guys know them all too. But some have survived and some have thrived. Look at Dan at Genesis. I mean, they're putting out record numbers all the time, it seems, right? So what's left is being, are the very relevant firms. But then again, the question is why would a $5 billion CTA or hedge fund, who's looking at Bitcoin go up down, what's going to get them to say, hey, you know what, I'm going to come into this space now? Ray Dalio at Bridgewater, I mean, he can't touch Bitcoin. It's just so small, right? I mean, he $250 billion market cap market. Maybe Bitcoin goes to 40,000 and it's a $1 trillion market cap, people are going to pay attention to it. They're going, oh wow, it's $1 trillion market cap now. Now I can actually put some money into it and it'll be relevant to my portfolio, right? But there's too many big funds that's just completely irrelevant to what they do because the market cap just isn't there, liquidity isn't there. But there's a lot of smaller CTAs, very nimble, active trading shops that can, but they're afraid to come in. And I talk to these guys. I'm sure Dan, you talk to them, and you guys all talk to them. I guess to me, what is the next evolution? Where are we a year from now in the evolution of this ecosystem of this industry? Are we where we are now, which would be, quite frankly, a big disappointment if we are. I think we're on this because we think it's going to grow and expand. But it's and I think a lot of it has to do with trust in the ecosystem and the custody and the safety of those funds. And maybe to Peter's point, I mean, maybe the prime brokers, there's this massive KYCML because they don't know where the coin comes or the money comes from. So there's a lot of people you go and talk to. At least as far as custodians are very leery about taking the money, but let's say we solve that. And how do we get this to $1 trillion market cap a year from now or 2 years from now, where that number is from where we are now?
So I'll tell you a couple things I've noticed. Number one, how we do it. We pump up a bunch of stock ideas, just like how the tech bubble, went up so high and has had many little bursts along the way. That's how you do it. Because people want to go where the ideas are. That's the other. But honestly, to get from the grassroots level up, we're going to have another technology innovation that covers the biggest problem with Bitcoin. And that's there's no recourse if you lose your coins. There's none. You lose Bitcoin, you've lost the world Bitcoin. You're not getting it back. We have to figure out a way to stop that. And once that's in place, I think there's going to be a lot more interest, and a lot of those custodians will be interested. But yeah, I've had the same issue. I've had people come to me and they're like, I love to invest, but I'm scared. What happens if you guys get hacked and my coins are taken, right? You ask that to any other broker or investor, asset manager for equities or whatever, and they'll tell you, oh, no problem. We got you covered. We have insurance. We have these options for you. Bitcoin, you're going to get a whole gamut of responses, and none of them will be sufficient. And that's what we got to solve first. One of my pet peeves, at least.
Dan, what do you see happening at Genesis? I mean,
Go ahead, Tor.
I'm sorry.
I said, what do you see happening at Genesis?
I'll start by getting back to echo both the comments that Morgan and Tori just made. There's no doubt the space. If we go back to 2018, even during the depths of the crypto winter, I think a lot of us would agree that people in the space, in the industry, firms and individuals really believe that we're on to the start of true institutional money coming into the space, right? There were a lot of signs of it still popping up through 2019, but unfortunately too sparsely. I'll go back to one example. At some point in the spring of 2019, Morgan Creek was able to secure an investment, not just in blockchain related companies, but in actual OTC coin by two separate government pension funds located in Northern Virginia. Okay. A lot of people look to that as a tremendous harbinger and expected more of the same to come. Unfortunately, we have not seen that en masse. We haven't seen that in a truly widespread way in the space. So it's been disappointing to those of us in the space who are focused on building the necessary infrastructure and playing the convergence play and expecting a broader level of mass adoption and evolution in this ecosystem and in this market. Because without that fuel, yes, Ray Dalio can't get into this market tomorrow. He's too big. He can't take any position. Even the tiniest little kitty position for him would ripple a market of this size. However, I think we all believe that in the next 5 to 6 years, hopefully sooner, that smaller versions of Bridgewater, et cetera, can get into the space and make investments, not just playing CME, not just indirectly investing in blockchain related companies, but actually buying OTC coin, starting their own funds, getting invested in the asset class, et cetera. We haven't seen it. Morgan's absolutely right that we need security. We need a true level and acceptance and a reality of custodial security for real institutional investors. We all know what they expect. I worked for 2 separate custody banks over the course of my career before digital assets. And so we all understand what those institutions expect. And if they, some of them today take a hard look at what is digital assets today, and it's not sufficient enough for them. And in many cases, those risks may still outweigh the rewards. I think they will come around. Bitcoin price rising, price of other assets in the market rising will all help, but we definitely need a much higher and more secure, more transparent level of security for their assets, whether it's cold wallet, warm wallet, hot wallet, whether it's on exchange or off. It's got to get easier and more transparent and truly more secure for them.
That's great points there. What are you guys' thoughts on decentralized exchanges, and why haven't they caught on and become more of a thing and have more liquidity? I think right now they account for probably 2 to 3% of the volume of centralized exchanges.
I can get to this.
Go ahead, please.
When it comes down to decentralized exchange, so guys, there's a little bit of a disconnect because I'm talking more from, say, we definitely have some institutional players slash high net worth individuals. You guys definitely talking more from the institutional perspective side. What we've seen from the retail slash high net worth individuals slash some of the institutionals is they still consider Bitcoin as a speculative asset because, unfortunately, again, there's not too much trust in terms of who actually is in control of the supply. Now, when it comes down to decentralized exchanges, the reason why the decentralized exchanges did not really take a much larger market share as they were supposed to, relative to traditional centralized exchanges that are completely draconian when it comes down to fees, that have absolutely bad liquidity when it's mostly needed, and that bad liquidity typically is going along with quote tech problems, and the website is just not responsive, where there's a huge conflict of interest between centralized exchanges, because those exchanges are both the broker and the exchange. So there's a clear conflict of interest, and those exchanges make money on their users. Still, the reason why decentralized exchanges did not really pick up is because A, they did not bother to build proper communities in the first place, and second, people invested in crypto the majority of them do not want to educate them. They still want the same Gmail kind of service where you log in, you forgot your password, somebody has the password. Nobody wants to take that responsibility. That responsibility is being outsourced to centralized exchanges, and therefore they charge those fees. So that's, in my opinion, the top two main reasons why decentralized exchanges are not really picking up.
Yeah, I think the second one you named is probably the bigger reason. We've seen the same thing on our side, is that people are kind of reluctant of managing their own keys, as much as that's really important for security of your offline holdings, if you're holding assets in your paper wallets or hardware wallets. But majority of the people aren't very savvy to be able to do that. So they feel much more comfortable with the Coinbases and the Krakens and the Binances holding their money, because if they the exchange gets hacked, the underlying the comfort that they get in their mind is that somebody's there that they can contact and they will do something about it. But self-custody, as much as it's a nice feature of this whole paradigm shift that's going on, it's hard and it's not for everybody. And to Dan's point and to Ture's point, that we need security and we need insurance. All these companies out there offering services need to be able to provide assurances that your assets are safe and the platform that you're dealing with is secure and it's performant and reliable. Those are the values that underpin what we do at Quantancy as well. Our focus is really those, user experience. When somebody wants to place a trade, they don't want to deal with downtime. Exchanges often go down, but their APIs are working. So often you'll find that trading through our interface still works even when the exchange is down. So yeah, there's a lot of points to note on why DEXs haven't caught up, but eventually I think they will continue to grow and provide an ever increasing share of the volume.
Dan, sorry, I interrupted you. Go ahead. Sorry.
Can't actually hear Peter and Rosh's points on this. You raised some really good points. The common thread I heard in that was user experience. And as we all know, whether we're talking about trading or where you go get your favorite hamburger or where you buy clothes online, user experience is extremely important. Just thinking is now it gets there. But that's actually, I have to admit, I never used a DEX. So, but I've read about them and I followed them since before I got into the space. And what struck me about the concept of a DEX versus a centralized exchange, which is where I come from. I used to work for a firm called EBS, which was at the time, this is years ago, things have changed a little bit in the institutional interbank foreign exchange market, but at the time it was the world's largest G10 spot FX platform. It was owned by a bunch of banks, and then it was sold to ICAP. All those folks now work for the CME. It's a CME property now. But the point is this, we would spend a lot of time looking at market macrostructure and market microstructure for these centralized exchanges, which really basically, I worked for an ECN, not an exchange, but what that means really is it was an electronic communication network. It was a matching engine. That's all it did. It had a broker-dealer model, right? But its job was to run the technology of matching orders super efficiently And that means handling a lot of incoming data back and forth to the matching engine and back to all the participants. And sometimes a lot of intermediary layers, such as the PBs, et cetera. My point is this: it was all about being performant. It was all about being super reliant. It was all about never going down. Okay, and the in the real world, the Wall Street, the successful exchanges never go down. Okay, philosophically, someone who might say I'd prefer to deal on a DEX would say, well, this is also distributed; it won't go down. But however, they're leaving out the fact that there's all these other performance issues that come into it. Like, how does one measure latency when you're posting bids and offers on a decentralized exchange? When exactly did it hit that nexus? When was it posted to everybody? How long is the average time for people to respond to that, to get acts? What are average hit rates, fail rates? Like, is there any way to actually measure that? I'll ask the technologists on the group, but I'm guessing the answer is when compared apples to apples, you cannot make the same comparison to a properly run, technologically performant centralized exchange to that of a DEX. And I think that it may not have been the biggest impediment to date as far as the lack of adoption and growth and volume growth in those changes, but I think in the long run, it will keep the vast majority of institutional players off. I'd love to hear what the rest of the group has to say.
Dan, why can't you measure the performance just by the bid-ask spread in the order book? It's pretty simple, and the order book has to just have no fake volume, which is also pretty easy to have.
That's an interesting point. So are you saying that I just want to make sure I understand that. Is it more or less easy to strip out the fake volume in a DEX than a centralized exchange?
First of all, 100% yes. But secondly, the measures of latency and the measures of efficiency of an exchange could be just figured out by liquidity. And liquidity is very simple to estimate.
Absolutely. Yeah, you're absolutely right. It's all about liquidity. That's all that matters when you're running an exchange. Absolutely. Some of the other performance measures, I think they are important, not just HFT traders. I mean, to anybody else looking for certainty of trade, looking to truly measure transaction costs. I guess part of what I'm saying, Peter, is I don't think I really fully understand how a DEX operates when compared to the world I come from.
DEX pretty much puts all the trades on the ledger, and the ledger is decentralized. So therefore, that ledger has all the features of the of the blockchain, immutable ledger, blah blah. It's obviously slower. It's potentially slower.
Ledger in real time, though, are they correct?
Most of these DEXs are currently running on Ethereum, and they're essentially just a smart contract, which is in more slightly layman term, a script that runs every time you call, every time you send a transaction. So if you're putting in an order to buy a limit buy on a certain asset, it will go in and get included in the next block that's mined. So the latency obviously is a huge issue with DEXs because you're limited by the block time. So with Ethereum, it's in tens of seconds sometimes. So that's one of the.
Absolutely. That was my point. Thank you. And I understood Peter's point as well. Absolutely. And honestly, I would love to see DEXs not just continue to evolve, but actually, kind of make a run and add value to the space and be not necessarily a venue. I still don't believe they'd be a venue of choice for larger players, but I'd like them to be a venue, an option out there. So I think they actually improve the level of execution and of liquidity options in general, in aggregate across the space. But that latency issue is something that has to be dealt with. It has to be addressed.
But the latency issue, the losses associated with manipulation conducted by the big boys in the crypto markets are much larger than any latency issues you have at this moment. Plus, if you're trading large blocks, all that stuff could be matched easily on the back end with smart contract. Easy, super easy. If there's proper, not fake volume out there, which is the question.
In the world that I inhabit, digital assets, we're going to we effectively, quite frankly, from a regulatory standpoint, we have to avoid dealing on those exchanges that engage in, for lack of a better encapsulation, bogus methods. Whether it's allowing manipulation, whether it's manipulation by design, whether it's posting wash trades, a lot of this activity. At Genesis, ourselves and most of our clients that we deal with in North America, they're only dealing on regulated exchanges. Now, the fact is that means that the liquidity around the world isn't able to join one true global pool. That's a problem for crypto. FX has gotten beyond that by going outside of regulation and yet sort of coming up with its own global codes of conduct and better methods. It's not perfect by any means. We could spend hours talking about equity market, FX market, digitalized, what's the best model. But you make a good point about the bogus volume on these exchanges, particularly those in Asia. But anything offshore U.S., for example, it's something that we systematically avoid where I work.
This is a question for you, Peter. I mean, people talk about this fake volume all the time. I get it. There's fake volume, and whatever. But how is that fake volume? Are you using volume as part of your indicator? I mean, how is that fake volume affecting you and your signals?
It does not affect us and our signals because we do artificial intelligence stuff. So obviously, we cannot be right 100% of the times. We are correct about 55 to 60% of the times. But for average retail investor, those fake volumes are absolutely misleading. Absolutely misleading.
I don't disagree with you, but how is it affecting their trading? If I have to go buy 0.02, if I go buy 0.02 Bitcoin, I mean, as a retail trader, I have $1,000 in an account, $5,000 in an account. I go to buy 0.02 or 0.03 of a Bitcoin. Knowing that some exchange is inflating their volume 10 times. How is that affecting? I'm just curious. How's it affecting my trading? And if you're using artificial intelligence, aren't you filtering out random noise?
We are filtering out random noise, but not everybody is trading with our signals and our analytics. I'm talking about an average retail investor who sees lots of fake volume, makes decisions based on that fake volume, gets burned because of that fake volume. They do not want to buy 0.02 Bitcoin. They want to buy it and sell it in the next hour. And they want to do this 10 times a day. And they do have all the right to do this because they're retail investors and they need to get access to volatility. That's why they're risking investing into an asset that pretty much has not much insurance out there, etc. So they're getting burned completely. Absolutely every day. Not only by the fees, but also by the fake volume. Wouldn't you agree with that? So you're saying that retail investors, so the fact that there is 90% of fake volume out there.
Listen, I agree with you. I agree with you. There's fake volume. I'm just curious, knowing that there's fake volume, if I'm a trader and I'm looking for liquidity and I go to an exchange that's claiming they have X, in reality they have a quarter X, I mean, Morgan probably figure this out. I mean, if you're a sophisticated trader and someone's telling you, and we saw this all the time in FX, you hear it all the time. People inflate their volumes.
Guys, it's called spoofing. I mean, that's illegal. That's illegal for everything but crypto. Like, come on, guys. I mean, everybody gets burned by that stuff. When it comes to retail investors, really get burned.
So you're saying there's fake bids and offers, is what you're saying?
Fake order book, absolutely.
Fake order book. Yeah, I mean, I don't disagree with you. I mean, I agree with you, but I don't. Maybe these retail traders are pretty sophisticated, trying to be sophisticated, looking at the order book. I don't know. But I will say my time in foreign exchange for years. I mean, you can still in foreign exchange is deep, right? I mean, Dan was talking about EBS, and there are still high frequency, whatever you want to call it, AI type firms that can find the random, the non-randomness, and that's the thing about a fragmented market, right? If you have a proper PB and you have access to the main ECNs where the real volume is, as you want to call it, there's still opportunity, and that's why a lot of quant prop shops and HFT shops still can make money in it. And in the crypto world, and I've spent a little bit of time now watching the order books, and whether the orders are real or not, it's pretty easy to identify where the bots are and who the bots are in those books. And if you're manually trading, it's pretty easy to see how these guys react. And it doesn't, you can actually almost visually see it. And I know you can pull some of these exchanges up and you can see how these order books skew. And if you actually trade on them, it's kind of fascinating actually to see how they react. Which says to me that there's could be, someone really dives into that and you can find some information in those order books, especially if you're watching multiple order books.
It's easy for 20 institutional players out there. It's difficult for everybody else.
How many exchanges are you connected to, Peter?
5. Oh, how we're looking into 14 exchanges. We're working with 5 for the execution.
So how would you choose the 5 you chose?
For the execution? Fees.
Fees?
Absolutely.
So nothing to do with volume or fake volume, just fees?
Fees and more or less certain level of security when it comes down, just to make sure.
Would you say there are some exchanges out there that have more information and more real, let's say, than other exchanges?
That's official. There's an SEC research conducted the research not by the SEC, but presented to the SEC, showing the
Okay, so are you on those exchanges? Are you on those exchanges, or you went to the exchanges just because they have cheap fees?
We are collecting data from 14 exchanges, including exchanges with fake volume, because we still would like to see how the price is moving. The correlation between prices is still okay. However, when it comes down to actual execution, we look into proper fee structure and proper security. And typically that very well correlates with not too much fake volume exchanges.
So do you derive your signals on one set of liquidity pools and execute on another?
We are agnostic to, I mean, the liquidity we're dealing with is not like, we're not trading million dollar blocks per day. Our trades are much smaller in size, but still important to us. So we're pretty much fighting with you guys. Whom you're.
I'm just curious. I'm just fascinated by how people, implement their structures. So.
Mm-hmm.
There's some research out by the block about volumes on real volume exchanges recently, and I think they pointed out that I think April was one of the highest, and it's kind of dropping now. But the exchanges they included in the real volume exchanges did not include Binance. So I'm curious to know what your guys' thoughts are on what is considered real volume. Is a trading pair based on Tether, for example, is that worthy of being considered real volume, or does it have to be a purely fiat pairing?
If you look at the Asian context, I mean, for example, let me start by asking you a question in response to that question, because I don't know because we're not allowed to trade on Binance at Genesis, but on Binance today, roughly, what's the ratio of BTC traded versus USDT versus the ratio of BTC traded versus USD on any other comparable exchange that's competing with Binance? What do you think? I mean, roughly, what do you think the ratio is?
I am looking at it right now. So BTC traded against Tether on Binance, there was about $687 million tethers worth of volume in the last 24 hours. That's number 2, and OKX had with tether pairing of BTC, they had 713 million, so they're number 1 in the last 24 hours. Then there's
that's highly relevant, right?
It is relevant, I think, personally, but I wanted to get a take from you guys.
Number 3.
The whole world was trading in the same pool. Getting back to both your point and Peter's.
Yeah, number 3, at least today, hit BTC 377 million. Then Liquid, which has a JPY pairing with BTC, 172 million. And then it's number 5 is Coinbase with USD pairing 147 million.
It's not even close.
Yeah.
And that's why we see the 2-3% spikes in price every day, because the actual liquidity is so tiny. And this drastic conflict of interest within the exchange, which unfortunately we have to all use, or you guys can use liquidity providers, etc. I mean, that is a problem for both retail and institutional investors. Institutional investors do not want to get exposure to something that just they do not want to invest more than 1%, maybe more than 0.1% into something that can just move by 5% just because somebody decided to make that manipulation thing. We catch those 6 times a day on average.
Anyway, I think that liquidity is more of a concern for players, for retail guys that, like you were saying, want to buy, sell constantly, a couple of $1,000s worth of crypto. They're more concerned about the user experience of the exchange and the tool set that they offer, and who has different strategies that they can run, possibly, or even who has which exchange potentially has the most coverage in terms of the number of assets that are offered. Because I think a lot of retail guys believe that they've missed the boat on Bitcoin, so they go and start dabbling with altcoins that can go up, a couple 100% in a matter of days and weeks. So it's a whole different world on the retail side, but a lot of these things that you guys are talking about, why institutional money isn't coming in, it's largely irrelevant to retail traders. How much time do we have? We're over an hour and 15.
Peter, so I mean, all this fake volume. Who do you? I mean, I'm not asking for names. I'm just curious. What sorts of players do you think are showing this fake volume in the order book, and ultimately, what's their reasoning for doing it? I mean, I have my opinions. I'm just curious what yours are.
Reasoning for doing that is very simple. So since it's unregulated, you can drive intraday liquidity very easily. You roughly need about $1 billion to drive the price of crypto, of Bitcoin, by 3%. All the other assets will correlate as well because of arbitrage. And then you can clearly see within 24, 48, 72 hours how that same spike literally drops by the same amount later. And that's been like this for years. Not like I mean, everybody knows this. It's like everybody knew that since.
If everybody knows this, is everybody knows this? Isn't there someone making a fortune after knowing this? Absolutely.
You can guess who. And if I say that publicly, I don't have the names, and I won't know the names. But absolutely, 100%. 100%. There's a reason for that. So that's why the fake volume needs to grow, just to give the emulation that crypto is as liquid as water, as liquid as Forex. But it's not. At this moment, it's really not. And the main reason is not about attracting capital. The main reason into the space, which is definitely a big matter. The main reason is education, and the main reason is to bring and educate large, mostly represented communities, and those communities, unfortunately, will be outside of the U.S. and UK. That's emerging countries.
So if I said, hey, I need to buy 100 Bitcoin right now, what do you think my slippage would be if I just went to an exchange and had to do it?
So let's just compute that. So we have 100 Bitcoins times 10 grand. Let's just round it up, right? So that's 10 mil.
Mm-hmm.
The liquidity of Coinbase Pro is what, 150 mil per day? That thing is valued at $8 billion, right? Just FYI. Count the slippage. You're 10% of the volume. I mean, come on. So, and that's not a large block. That's not a large block. And would you go with that
question before? I mean, what's your opinion on these non-exchange LPs that show prices on 50 or 100? Have you talked to stuff like that? Do you think they're adding a service to the industry?
100%. They're definitely adding the service to the industry. I mean, They just bring absolutely 100%. No. Any source of proper liquidity is great, and that's what they're doing. They're sourcing liquidity. They're using some artificial intelligence, high frequency trading on the back end to make sure that you can source this out. It's very, very good. Can't say that it's bad. Again, it's made for institutional investors, and institutional investors making the most buck. So when it comes down to institutional investors growing its presence in the crypto, it's both bad and good, but it's definitely increasing. The presence is definitely increasing. So that's a sign. Something.
Yeah. Well, I mean, I can certainly see a two-tiered liquidity pool. One, you got the exchanges, then you have non-exchange LPs. And, if I had to, try to execute, large size, why wouldn't I ask 4 or 5 of these non-exchange LPs and say, hey, I want you to give me a price on 5 top of coin or 10 top of coin, top of book or 50. And and your aggregated book spread should be tighter than any individual LP, right?
Yep. And made a mistake. Somebody mentioned that it's not 10 mil.
Yeah,
it's 1 mil. Yeah. Sorry, guys.
Yeah.
Sorry.
So
1 mil is not going to be that influential, but definitely going to move the market for 100% sure. 100%. So you have to stay. Also keep in mind, if you go to exchanges, if you do not have proper negotiations with them, if you do not trade very often, the market rates are much higher than limit orders.
yeah.
Right. So unless you trade like consistently, but then if you trade consistently, you do have relationships with them, and you definitely have relationships with other players. And if you trade consistently, chances are you're trading on all the other exchanges, and then quickly you'll realize that you can actually move the market, and quickly you realize that when you move the market, there are not too many consequences if you domicile outside the U.S. And then you realize that why not just base the strategy based on that? That's the take. So unfortunately, lots of conflicts of interest. Is that going to be over? Yes, at some point of time, absolutely. Is it a bad thing? No, it's just how every single asset has been, every single asset has been going through those steps to mature. So it's just normal.
Someone's asking, what is your, Mark Anthony's asking, what is your guess as to the amount of Bitcoin that is trading out of the 18 million total? I'm not sure what that's referencing. I may have missed something, but
I actually did the analysis recently. Well, looked up the stats. Unchained Capital, I think they estimated 60% of wallets holding for more than 12 months. So therefore, 40% is left for the actual float from the wallets. But then when it comes down to actual trading, it's even less. Just that's the stats, publicly available, guys.
okay.
The level of turnover amongst that 40%, like how often does it churn? I don't know. It's pretty. You probably hear some very wide estimates on that.
Hard to really gauge the number, right? A lot of guesstimation going on. Whoever put that stat together.
Very exact number that he came up with.
Yeah.
And I had a question for you. So, up until, mid-March, the whole talk was, people should diversify and get into digital assets, and because it's not correlated with the, stock market, right? And then it seemed to, get correlated, for whatever reason. It seems they bottom, stock market side, Bitcoin side from that time period of time. What's everyone's view on the Bitcoin being diversified and not correlated to the stock market? Or is it correlated to the stock market?
I'll tell you what we do. We look at it as kind of a risk-off hedge. So sometimes it depends if it's like, for example, in the last stock market dropped, it went alongside all the investors and fell roughly, at the end of it, it fell like by what, 30, 40%, 25% down for the month of, March, basically. And, the reason was because that there were a lot of margin calls. So it really depends on who's investing and why. And I think there's a few levels of investors because, again, it's not liquid enough and diverse enough that we have the whole world investing in it. We still are early adopters. Everyone in this chat is still an early adopter relative. So you have this differentiation between the investor classes. I would say you have at the top, the newest, but they're also the most heavy hitters, is you have a sliver of institutional money. We're talking like sliver of the probably 100 trillion of institutional money. You got like a tiny fraction of that coming in. And they're actually one of the biggest, I'd say, movers at the margin. So when you have something like, a big market crash where the market's selling off, you have to make your margin call on a lot of different assets and sell to cover or rebalance. Then you see Bitcoin impacted. I think day to day, though, I think it's pretty like even as far as what you're going to see. And that's where over time, you're going to see kind of a complete break of any correlation. I used to think it's a risk on asset, but then I realized that it's only risk on when you have these guys at the margin coming in or out. But it actually might be a risk off asset, and it might be a hedge for a lot of other, assets that are going to fluctuate. So it's going to be very interesting to see because it doesn't fit. Just like we try to categorize it. What is it? A commodity, a currency? Is it, company asset? It's kind of a new concept of, how you treat something to invest in or buy. And it's the same thing for the correlation because people don't know what it is. These correlations are going to come and go. So yeah, there's a lot of, like I said, there's a lot of drivers like margin call, or just, there's going to be another one too, which is international currency crises. A lot of people aren't going to be able to buy what they want to with their local currency, and the black market will have it for them. So the black market's going to say, hey, give me Bitcoin. Yeah, it's going to cost you, $1,000 for, a couple pounds of meat now. So, or you could give me, just a fraction of a few Satoshis and, I'll take it. So I don't know. I think we're going to see a lot of correlations break and change. So based on just my logic there, it's not really correlated directly. That's the way I look at it. I'm curious what other people think.
Back to what you talked about as far as the experience that investors of all sizes have in emerging markets. You were talking about someone who's worried about the actual so-called official exchange rate of their local fiat versus USD. And therefore, that's one reason why BTC is looked at suddenly as a much more safe alternative, which I totally agree with. But to go further beyond that, to extend that argument and that concept and that narrative, what about stable coins? I wanted to ask the rest of the panelists, what are your thoughts about growth of stable coins going out the next 12, 24 months compared to what we've seen in the last year? My personal thesis is that stable coins weren't the story of 2019 or 2020, but they're going to be the story of the decade. I think that the expansion and the growth of these use cases, and not just in emerging markets, but that's sort of where we're most acutely felt the need for it. But even beyond that, globally, I think we're starting to see, and this isn't just about traders who need, grease in the wheels. Let's say Tether to trade BTC on Binance, but real world use cases in the import export business, real world use cases for those looking for a safe haven or worried about apparent weakness in their local fiat. What are your thoughts, the rest of the panel? Crickets.
Needs to be backed up by real liquidity. Cannot be backed up by somebody in the chat mentioned. We will never know if Tether is backed up by USD 1-to-1. It's not. There has been a story how it's like over leveraged already, and if we're not gonna enter into a deflationary state globally, then chances are the stable coins are just not gonna survive. They're gonna start taking risks, and then conflicts of interest again. It has to be
I agree. I think there's a huge appetite for stable coins across the globe. It's just the ease at which you can move money on blockchains is attractive, and the appetite is there. I think you can see the initiative by Facebook. The Libra, it got shut down, but it's very relevant to what they were trying to accomplish. And I think stablecoins are kind of filling that void until someone large and reputable has a lot of reach is able to pull something off on a more global scale. So I think stablecoins are going to continue to grow, and they might end up fueling the growth for the Bitcoin's bull run, next bull run. I think everyone's anticipating post halving, if the cycles repeat, then we should see an all-time high in the next couple years. The last one was rumored to have been fueled by Tether, but now we have a lot of other competitors against Tether, although they're much smaller in size in the market cap than Tether still, but they have a role to play, and I think we'll continue to see the market caps growing with stablecoins.
It just if a stable coin is supposed to be pegged to something like $1, right? And I'm by no means an expert in this, but it's supposed to be pegged to $1. Why do people pay 8-9% to borrow it or to lend it?
That's exactly the question. That's exactly the question.
I don't know. I mean, my theory is I'm curious. I think you guys are smarter than I am, and I know there are smarter people than me out there that have their opinions. But I'm curious what you guys think about that. Why? I don't know. Tell me. I don't know.
The smart people who know how to sell things. That's my comment.
Okay.
I mean, maybe it just comes down to that's the premium you pay to have the convenience of being able to move it whenever you want and wherever you want across the world. Although a lot of the stable coins are highly watched and there's a lot of channel analysis that goes on, and there's KYC attached to most, if not all of them. So yeah, it's the premium that people are willing to pay. I don't know what the reasons are, but they're paying it.
I think what I've noticed is it's basically a way of keeping your money in the local currency, but existing outside that currency's de facto financial system. That's basically what it is. It's like a bridge between the regular fiat world and the crypto world. And people are, like China's exploiting it because they're using it as a bridge to the US dollar world via the crypto world, and sometimes vice versa. But it's very interesting to see that kind of concept play out. And yeah, I think you're right. Like, as more and more people become aware of it and more players get involved, I think you're going to see countries starting to actually issue their own kind of stable coin version so people can get into it. I don't know, like I totally get the fees though, because I mean, just from our perspective, whenever we want to convert US dollar to Bitcoin, or especially Bitcoin to US dollar, just because of all the issues you have to deal with, KYC, AML, cross national, whatever jurisdictions, it just invites a ton of risk. So if you can keep it all digital and not have to deal with an archaic system that doesn't serve your needs, and is really set up, over 100 years ago, then, all the means but better. It's like, it's like trying to drive a car through a city and being told that at one point you're going to have to get out and walk your car or push it. It's insane. So those are the kinds of things I think that, you're going to have stable coins, at least until everyone is like on one, de facto currency that everyone accepts. But I don't know. I mean, it's a technology, so I don't think we're ever going to get there. I think it's going to constantly evolve. But, Bitcoin was the first. So, people are going towards that. We have Lightning Network. You have mini bridges to make it feasible. But yeah, I think these stable coins will just keep going up, and, they'll come and go, but they'll be needed as bridges. Head out.
Okay, I have a hard stop in a couple minutes here, so I'm gonna have to get off. But it certainly was educational experience for me just talking to you guys. I really appreciate the time and Anna putting this together, and the guys at the blockchain. It was good, and first time doing it, and looking forward to doing it again. I think that was a good experience here. So I have to run in a second here, and I want to say nice meeting all you guys. Dan, I'm sure we'll see and talk soon, and Morgan and Peter and Rosh. Let's connect, and love to chat with you separately or independently, and we should do this again. And next time we're gonna have the blockchain happy hour or something. So
absolutely
nice.
Blockchain cocktail.
Thanks, guys.
Thank you, guys.
Yeah. I have to run too. Very nice chatting with all of you. Surely when quarantine's over, we can grab some beers in New York if you guys are around. So
we'll have the blockchain COVID-19 happy hour.
Yeah.
The first round's on me. You got it.
All right.
Guys, any last thoughts? We got halving coming up in 5- days now. So what do you guys think? Any last thoughts about that? Anna says bye, whether she's on there.
Yeah.
Not investment advice. Probably bullish. Short term, at least.
yeah, I mean, patterns,
Bye, guys.
and we'll see a big one.
Toddle.
Toddle.
All right, guys. Thank you very much.
Thanks.
All right,
Nice. Stay safe, everybody.
Guys,
Bye-bye.
have a good night. And thank you to the Blockchain Center. Thank you
All
very
right.
much, the Bitcoin Center. I appreciate it.
Thanks all. Take care.